A crypto chain worth more than the annual GDP of some countries was brought to its knees by a well-prepared for and well-known bank run scenario. Let's go through just what happened and some learnings we can take away from this collapse for future investments. Terra started as an e-payments platform, really only offering its algorithmic stablecoin for the Korean won. The Korean won used the same mechanism that we see in Luna today, where it burned 1 Korean won worth of Luna for each Korean won KRT, in this case, that was minted. Do Kwon then saw the opportunity to expand his market. The way he would do this is to expand into a layer 1 chain that would give many more use cases for his algorithmic stablecoins. And that's where the Terra Luna L1 chain originated. By creating a smart contract supporting blockchain, there would be many more use cases for the algorithmic stablecoin that he had created. This strategy was wildly successful. The number of transactions and users on this L1 chain continue to grow over time. This growth in the algorithmic stablecoin and the L1 chain acted as a flywheel. It allowed for more developers and more new entrants to come to the ecosystem and continue to build on top of Luna. This rapid growth led to a flywheel of growth that increased the number of users, developers, and new apps being built on Terra. The real problem underlying this growth was Anchor Protocol. Anchor Protocol started as a way to offer yields in an easy way to users using UST, and by allowing users to deposit yield-bearing assets like Ethereum and Luna in this case. Much of the growth in the Terra ecosystem was catalyzed by the Anchor Protocol. The Anchor Protocol offered 20% flat returns on UST deposits. At first, this was okay. It was somewhat sustainable given pretty high DeFi yields across the board. Over time, much of the yields in DeFi fell dramatically, and often you were seeing 2 or 3% real yields. As yields in much of the larger DeFi landscape decreased, Anchor Protocol stood steady at 20%. As a result, more and more money started to enter Anchor Protocol, and the deposits increased dramatically. At the same time, the number of yield-bearing assets within Anchor were pretty low, so there was no easy way to sustain this massive influx of Anchor deposits. At its peak, Anchor would need $2 billion annually in external capital just to keep its 20% deposit rate. It got so dire that Do Kwon had to step in with nearly $500 million to backstop Anchor, but they still didn't decrease the yield until later. In April of 2022, there was a new Anchor proposal that was passed that decreased the yield in Anchor Protocol over time. Now, while all this is happening, the Terra L1 chain is on a tear. Terra was one of the best performing assets of 2021, going from 90 cents to nearly $100 by the end of the year. That's a 145-time return on your investment. At one point, Terra flipped Solana to become the largest alternative layer 1 chain after Ethereum. Terra became so big that the Luna Foundation Guard was created. LFG was a nonprofit tasked with maintaining the UST peg. It was now clear for the Luna Terra team that Luna itself would not be able to backstop a bank run on UST. As a result, they decided they needed to buy billions of dollars of Bitcoin to collateralize UST with something other than Luna. They ended up buying about $3 billion of Bitcoin and $100 million of Avalanche. Now with $3 billion of Bitcoin, they were starting to move towards the direction of a fully collateralized UST. The problem was the UST market cap was nearly 20 billion. They only had $3 billion of Bitcoin thus far, but with hopes of moving it up to 10 billion and increasing the collateral ratio. Unfortunately, they didn't have enough time to move in this direction. Around May 9th, as Anchor yield had already started to decrease and larger macroeconomic worries around inflation led to a decrease in the market's appetite for risk, we saw the first UST depegging in a while. Now you can see with declining rewards for investing with UST on one side and increasing risks with the macroeconomic environment and rising interest rates, many large whales were out there to reduce risk, and UST was an easy way to do that. As a result, many whales started to exit out of their positions through the curve pool on Ethereum. There's some speculation that this was also a concerted attack. True or not, all these blockchains are open source. You can see where the money's going, where it's coming, and at the end of the day, if it can't sustain itself through an attack, then if it didn't happen today, it would happen at a later time and hurt a lot more people. In this case, it's a little unclear. There has been no clear evidence in either direction whether this was something concerted or something that just happened as a result of the macroeconomic changes in capital allocation. Once UST was knocked off its peg, it incited a panic, especially with the broader market conditions. More and more Anchor users began to withdraw their UST and exchange it for any other stablecoin at a loss. At the same time, arbitrage bots were buying up UST, exchanging it for $1 of Luna, and then selling Luna on the market to profit off of this depegging. Luna's market cap slid from $22 billion to $11 billion in the matter of a few hours. UST was no longer backed by $1 Bitcoin and Luna. Instead, it was backed by less than $1 of Bitcoin and Luna. Once UST became under-collateralized, speculators began to see the writing on the wall. Once the difference between the UST market cap and the Luna market cap became too large, it would be nearly impossible for a third party like Jump Capital to bail them out. And soon we were starting to hit those kinds of numbers. And so speculators took that and shorted Luna to zero, because that was now clearly the end state. This was helped along by the Luna Terra Foundation, allowing for greater and greater amounts of Luna to be minted in order to maintain the UST peg. Over this time period, billions of Luna was minted and then sold on the market in order to defend the peg on UST. So it became really clear over time that Luna would be worthless at the end of this. Once the Luna market cap was well below the UST market cap and the Bitcoin reserves were mostly exhausted in trying to defend the peg on UST, there was no real way left to save UST. Luna and UST had lost the one thing that kept the system alive, which was confidence in the faith of UST. The only way to have saved Luna after much of this depegging had taken place and the Luna price had fallen below $10 was for a major set of investors to recapitalize Luna. But unfortunately, there was no easy way to do that, because that would have led to a massive dilution of all the current Luna holders and a massive dilution for much of the community that already existed, hurting the chances of the community to continue after this event. Within days, Luna was trading below 1 cent. All hope had been exhausted, and top Luna Foundation Guard members like Remy Tito and Jose Mercado were tweeting about their massive losses, how they had accepted them. Trust and confidence in the chain and UST were gone. And much of what was built on top of Luna was really built around the UST algorithmic stablecoin and Anchor Protocol's 20% return. Soon, everyone capitulated, including Do Kwon. The new focus became preserving the ecosystem and the community that Terra Luna had built around its Layer 1 chain. At this point, this was the only asset really left on Terra's books. And that's where we are today. Luna is looking to start up again without its algorithmic stablecoin, UST. The same stablecoin that was the central purpose of Luna in the first place. It's still pretty early, and it's unclear where Terra Luna will go from here. Based on what we know so far, it seems pretty unlikely Terra Luna will be able to recapture the majority of users that they've lost. And without that market-beating yield of 20% that Anchor Protocol used to offer, Terra Luna has much less to offer new users. As a result, my expectation is much of the better development teams in the Terra Luna ecosystem and even some of the leadership will end up moving towards the other alternative L1 chains like Solana and Avalanche. Now, what does all this mean? The Terra Luna collapse was so massive and endemic to the crypto ecosystem that much of the larger market has taken a dive. For many, including myself, the words "do your own research" have found new meaning. I myself know many friends and colleagues that had overinvested in the Luna ecosystem. So I wanted to take a few moments to think about how I'm changing my own investments and what I look for in new investments as a result of what happened with Terra Luna. Do your own research. Outsourcing your investment thesis and strategic thinking is a scary proposition. If you had been following some of the top investors and research institutions like Delphi Digital and Jump Capital, you would be holding quite a lot of Luna going into this collapse. Know your risks, not just your rewards. It's easy to focus on the upside when the whole market is jubilant and everyone's making money. What truly matters is knowing your risk amid the jubilance. Luna had a non-zero chance of being hit with a bank run. Moreover, the statistics were not in its favor. I even made a video outlining this risk. But even then, the chances of a collapse felt lower than they actually were, historically or fundamentally speaking, because the jubilance around Luna was so great. Crypto is still young. Billions of dollars continue to get stolen with no way to recover them. And the majority of the capital in the crypto ecosystem comes from leverage. Adoption will continue at a sustainable pace. At the same time, we'll continue to see booms and busts in the crypto market as we have a long ways to go. Given the massive potential in the crypto markets, speculators will always have times when they will get ahead of themselves in order to try to find the next Ethereum or Terra.